We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Britton Financial Partners. This is episode number 98 of the Finances podcast, and this is a special one, Ben, because this is our first three-peat guest. So those people that have been long-time listeners, you go back to episode number 2, then episode number 65, you'll have listened to our guest, Mr. Adam Dawes, a senior investment advisor at Shaw & Partners. Adam, thanks for momentous occasion having you back on for a third time.
Great to be here.
Thanks, mate. Now, Ben was just showing his detailed agenda for today. We've had lunch, so we might be a little bit slower.
Full in the belly.
Bit full. How was lunch, Ben?
It was nice. It was good.
What about you, Adam?
It was great. I'd love to live here because that's fantastic food every day.
Yeah, that's Folklore. A bit of a shout out to the crew at Folklore, corner of
Dangerously close.
Paco. But we're not here to talk food. We're here to talk markets. And I thought one of the ways we might introduce this is, first of all, for those that haven't heard of you before, Adam, they can go back and listen to episode number 2. They can go back to number 65 and listen to your stories around your musical talents and your history before you got into broking. Very quickly, who are you? What do you do? Who do you work with?
Yep. So Adam Dawes, Senior Investment Advisor at Shaw & Partners. We advise clients on direct equities as well as we help financial planners with direct equities and basically anything to do with the Australian stock market. I've been doing it I've been at Shaw's 21 years this year and I've been advising clients for over 15.
And how long have you been working with us for, Adam, do you think?
3? So be getting 4, nearly pushing to 5 probably. Goes quick.
Yeah, absolutely. So it's been a great ride with you guys. And my business partner Sam was just saying that how impressed he is with your team and the longevity that you have in your team. Everybody sticks around and the culture I think is fantastic. So hats off to you guys.
Good on you, Sam. Everyone will listen to this episode now. They got a shout out. We wanted to start sort of macro, and one of the things I thought we might just reflect quickly back on episode number 2. It was called Russia, Rates and Recession. I'm not sure how many of the predictions we got right. I actually think we did okay. I think we talking about sort of macro conditions in the market. One of the things people get a bit anxious about is sort of world events and the impact that might have on markets. Maybe let's start at a macro level. You can start global, you can start domestic if you like, but just the underlying sentiment in the markets at the moment globally. I know we've got a US election coming up later in the year.
Yep.
Obviously some conflicts, Middle East and also in sort of Eastern Europe.
Yep.
Is that right, Ben?
Yep.
Never eat soggy Wheaties.
That's what I was literally doing in my head.
Yeah. So Eastern Europe. So what sort of impact are they having on markets more broadly? And then we'll drill down a little bit to sort of stocks specific and also Burke Britton specific portfolios.
Well, and there's lots of questions there. Look, I think certainly let's start with the US because I think that's the key, is that the US and what's happening in the US market. Certainly it's whether Trump or Biden gets in. Potentially Trump, I think, will take it out.
That's your prediction.
And say write that down.
Yeah, that's
Trump to win.
Trump to win. And then how do you future-proof your portfolio when Trump does get in? I think that's the key because he's very much centric America, and that doesn't bode well for a lot of Australian companies because he will then bring a lot of that manufacturing back into America. So, and then China's definitely going to be on the outer as such. So I think the biggest thing that we've seen in markets in the US is called the Magnificent Seven, the concentration of 7 companies that have basically driven the entire last 6 to 8 months worth of returns on just 7 companies. And those 7 companies are now NVIDIA, Microsoft, Google, Facebook, those kinds of companies that have really then driven. And Tesla is in there but hasn't really driven much. In fact, is been going backwards. But that has been a bit of an issue because there's such concentration of it. This reporting season is going to be very telling for the US as well as here in Australia on how those companies are going. Now, obviously, NVIDIA being the star of that concentration and moving higher, I do worry about NVIDIA because they only make chips in Taiwan. That's where they make their chips from. Now, if Trump gets in, potentially there might be some conflict and Taiwan might be in the center of that. You watch the largest company in the world now, bigger than Apple, bigger than anybody else, really struggle to get their chips.
What are they trading at the moment? Like at 60 times or something like that?
Oh, I thought it was more than that.
Yeah, I think it is 70 something,
Yeah.
70 plus.
Okay, kind of insane.
Ridiculous, like ridiculous. But it is one of the AI. So NVIDIA used to make gaming chips, now makes chips for artificial intelligence. And so it's just gone ridiculously, sort of skyrocketed. So they're about to do a share split. So you're going to get, lower price so more people can start getting in on it. But it's really interesting. And so I'm worried about Taiwan. A lot of the semiconductor producers have moved to America and are putting processing plants in America. That's still 3 to 4 years away before they can start manufacturing. And so you've got this issue where you've got the largest company in the world with some political tension that might happen. That's where it's going to be an issue. So I think inflation has been the biggest issue that we've had, and inflation is going to stay stubbornly high for longer. At the beginning of this year, everybody in the markets were talking about 6 interest rate cuts in the US and maybe 1 to 2 interest rate cuts here in Australia. We won't have any interest rate cuts here in Australia, and there are probably maybe 2 interest rate cuts in the US. And so what markets are doing, they've priced in a lot of those interest rate cuts. And so we might see after our reporting season a little bit of a pullback if those interest rate cuts don't happen. And that's when markets are going to come back to somewhat normal levels. So there's a couple of concerns that we've got going into reporting season, that earnings need to continue to keep moving. The banks here in Australia are going to have basically 0 earnings for the next 2 years, or flat earnings. So that's going to be a bit of a tough. And certainly our miners have been doing well. Iron ore still staying over $100, but we've had a bit of a lithium bubble that's burst. Copper is looking really, really good at the moment. So some of our commodities are still sought after around the world, but it is going to get a little bit tougher. The last 6 months has been pretty good markets. Things have been moving right. There's going to be some pockets of unrest. And the issue really is going to be around inflation, and if they can bring inflation back to that 2 to 3% range. And that's going to be the tough part. So the macro side of things, I think that's sort of where we are. We will follow what happens within America. I mean, it's sort of normally what happens. And if the US start to cut interest rates, I think they're going to try and do one cut before Trump gets in, because they just don't know what's going to happen after that. So I think that's where they're going to try and sort of position themselves. But as interest rates next year start to come back, that's good for markets, and that'll be good for Australia, and that will then help drive the global economy for another year. So I still think we've got another year to a year and a half worth of good returns. And then who knows, after that, once inflation is tamed, there'll be something else for us to worry about.
So there'll be another problem, as there always is, something else on the horizon. It's interesting with the rate story, and again, it's moved so many times. You're reflecting on, I think, episode 2, when rates were never going to go up, and then now they've flown up, and then everyone starts talking about them coming down, just talking about in Australia. And I'm probably, again, feeling like nothing this year. But at the same time, there's the political overlay where no one really wants to see to maybe bump them again either. So it's just hold where we are and just keep on holding. Is that your sort of take on it?
There's no way they're going to raise interest rates. I think that's sort of what's just suicide.
Yeah.
Now, remember that interest rates, pretty predominantly in Australia, this is where we should be. Like, this is our normal interest rate level.
Problem is there's a generation of people that have not experienced it, so they think they're supposed to be at 1.5%, 2%.
Well, that's the other side. Then they're waiting. People often, they're waiting for the fixed rates to get lower than the variable rates, which, again, we just had this unsustainable period of basically a decade where things were just weird. But that's maybe their only experience with it. So,
and also the difference is that those house prices are now, which you would have been buying for $200,000, are now worth $1.2 to $2 million. So everybody's up to their eyeballs in debt, and any kind of interest rate move higher is going to affect the economy. So, but the baby boomers, or the older people of the world, they're loving it. They're getting 4% on their cash. They've got no debt. They've got investment properties, and it's fantastic. So they're continuing to spend, and that's what's driving that inflation.
So is that why everyone hates the boomers? But again, I think it's a challenging one.
That's why you got to be nice to your parents and your grandparents, because you're going to receive it at some point, aren't you?
Yeah, and again, that's where government intervention, it's never going to work for every layer of the economy. Everyone's in a different situation. Our probably gut feel has been it's dragged a bigger gap between the top end town and the bottom. People who are battling already are probably battling harder, and those who were doing okay, had no debt, probably doing even better.
Yeah.
But they needed to do this. They needed to get rates up and slow things down, or it would have become a bigger mess.
The renters, it's like 15% rental increases year on year, right? So they're struggling, they're hurting, right? Then you got the middle guys, which is me, the mortgages, up to their eyeballs in debt. still doing okay, but you're starting to see that sort of pulling those strings back. So the baby boomers, or the ones that have got no debt, they're loving it. Mortgage people are just sort of holding on. And these young people, they're just really struggling as well. So something's got to break, and I don't know what it is. But if interest rates do start to come down, that will then fuel the housing bubble or fuel the economy. We've got immigration still coming in, which is going to keep our strength moving forward. But what's the growth after immigration? And then we don't really have much growth after that. So I think that's really, the government's got to do something with that. But the RBA, I think they've been doing a good job so far of tempering. And remember, oil prices is the fourth reserve government, sort of RBA reserve governor. If oil prices start to come down, that will then have a fantastic effect on inflation and actually will probably bring things down. So I heard the other day that OPEC cost them $1 a barrel to make. $1 a barrel of oil, it costs them.
What are they selling at?
100.
Well, its spot price is $80, 80 US.
Yeah, 80 US, so 100 plus.
Yeah, and they're doing 500 million barrels a day. Right.
Interesting with that, it's a couple of points here. Again, maybe this is drilling down a little bit, but talking about the banks not making maybe any money here for a couple of years, but you've got CBA running, again, recently, all-time highs.
Yeah.
And then you talk about oil being high, but I don't necessarily feel the oil companies in the Australian market have necessarily shown a lot of that on the upside as well.
Yeah,
Would that be correct?
Yeah, Woodside has been a horrible investment over the last sort of 6-12 months. It's just gone sideways to even lower. And then you got Santos, Beach. All of these guys are struggling with that. You would think that higher oil prices means that it should reflect in their share price and do better. But yeah, it hasn't, and it's been really, really tough.
Is that underlying costs, or is it just what is that not? Is it just the market not pricing that in? Is it maybe an undervalued asset, or it looked undervalued for 2 years and never really?
I think
it
is a little bit undervalued because remember Woodside took over all BHP's oil and gas. Probably a great move by BHP.
Yeah.
But, they've take over all of those oil and gas assets in the Gulf of Mexico. And they were supposed to, 2 years ago, to make this thing, that was going to be their saviour. And it's still dragging on the economy or on the business. So, yeah, Santos, again, they've all been underperforming, which has been a tough one. But OPEC is definitely, they're the fourth pillar of this inflation story, and they're really not beheld by any government, and they pretty much do what they want. So if oil does come down, which then transport costs will go down, things will start to move a lot quicker, then potentially we might have a chance to get sort of interest rates coming down as well. So it's a couple of things that need to happen before. But markets like lower interest rates. They don't like higher interest rates. And at the moment, we're still sitting pretty high, and we've seen the ramp uptick. And now we're starting to see that sort of effect that's really starting to, sort of going into the economy. So, watch this space.
You sound a little more pessimistic than you did in episode number 65, Adam. That's...
I was say, Jay said to me this morning, I don't think I was here for the last one. He said he was very buoyant about the markets. I said, he always is.
Yeah, well,
I'm selling stock. It's like a real estate agent. But
I think a year and a half, another year and a half of good returns. Yeah, another year and a half. I think this is going to do well. And we've had a GFC, we've had our once in 100-year COVID, sort of that kind of thing. So we've knocked all those off. Now interest rates ramped up. Perfect. We just need to see interest rates now start to fall, and that will return to good markets.
One of the interesting things talking about sort of pessimism, and we've talked about this on another podcast, is that one of the risks when you overly pessimistic about what might happen, what could happen, is that you do nothing and you choose not to invest. You choose not to deploy into the market. You choose not to be strategic with where you hold your assets. And I think one of the things that we've kind of emphasised, and one of the benefits of having the likes of yourself and Sam in our corner, is that there continues to be opportunities irrespective of what the market is doing. And the economy isn't the market. There is opportunity.
100%.
It's a pretty good point to make, even though I made it myself and I've just given myself a pat on the job.
It was a good job. But
I wrote that down because I thought
he did some prep, obviously. No, I get too many people just look at the headline number of the market too.
Yeah.
And again, often it does,
so
depending on how they're invested, follows
60% of the companies on the Australian Stock Exchange are materials-based companies, BHP, right? So materials or commodities. That's not representative of the economy at all. So if the US dollar's coming down and gold's going higher, our market will do well, because it's a commodity-based market. So, it is an older style market, couple of banks, couple of telcos and some supermarkets, but the rest of it is all resource-based. So it doesn't reflect the economy. So I 100% agree with you on that one.
See, good point, Ben.
Good work.
You always say that I never make good points on this podcast.
Sometimes.
That's the second good point I've made so far.
Broken clocks right twice a day. But maybe we're just going back a little bit, and again, people's obsession with the banks in Australia. And I think maybe there's an opinion they just make money every day of the week, no matter what, in all conditions. They're just getting richer and richer and bleeding people dry. Can you just give us a bit of extended commentary around that point of they're not going to make much money in the next couple of years, and then also maybe just reflective of, and I know CBA, just pick that out as an easy one, but how that's
so they will continue to make money, but earnings growth is going to be zero. Yep. So in other words, they will continue to make billions and billions of dollars.
But not more billions.
But so the growth is not going to be there. And you want to invest in companies that are in growing earnings or growing and in upgrade cycles, not in downgrade cycles, right? So you want that. So flat earnings growth, they're still going to make a lot of money. But it comes down to when you look at a bank and you look at what's going on, it's the net interest margin. So it's called the NIM. And the net interest margin is the difference between the money that you give them or in your deposits, they take off you, and then they use that money to then basically go out to the market and charge a higher rate. Difference between what they get the money for and what they sell their money for is that net interest margin. Now, a year and a half ago, CBA saw their net interest margin basically sort of sideways motion. And since then, the net interest margin has been getting crimped or is getting lower. And that's where they make all of their money. So there was lots of talk about the banks competing on mortgages and basically writing mortgages that they were going to lose money on for the next 20 years or so, right? Now, that's not a great business model because it's all about market share and grabbing that market share. Commonwealth Bank came out and said, no, we're not going to write these loans. We're not going to do that. We're going to stick to our guns and write these loans that are going to make money. The market liked that. But overall, the banks as a whole will continue. The one you should be investing in is Macquarie. And if we're going to see continued growth in the US and we're going to see continued growth around the world, Macquarie is the bank that you need to be investing in, not NAB, Westpac and ANZ or Commonwealth Bank, because they're domestically focused. But Macquarie is a global business, and that will take advantage of the next year and a half of good growth going forward.
I always think of Macquarie as a diversified bank more so than the others. Would that be
100%.
A simple way to look at it?
Yep. So they've got commodity traders, they've got agri traders, they've got all these other traders, plus all the deals that they're doing, plus a license to mortgages, all those kinds of things. So it's a big aggregator of different commodities and houses all into one. And they're very, very smart at what they do. They're very, very good. So that would be the only bank that will see earnings growth going into this year and next year.
We're going to stick on a few stock stories, or are we going to...
No, I think they overlay with what's happening, aren't they? So we probably sort of talked more about, again, the US doesn't matter who you ask, they drive everything realistically.
They do.
So that's obviously a big ticket item. And then how that flows through. Maybe just touching on maybe where you see opportunity, maybe things that have recently been added into portfolios for our clients, or things that you maybe got a close eye on as the next wave of things coming into that mix.
And just to add to that, you mentioned briefly about lithium and the bubble with lithium, and maybe just add that into the mix of where you see that playing out. Yeah,
so I guess let's start with the US. There's obviously lots of opportunities because there's been 7 companies that have been driving that earnings growth. That means that there's the 490 other 3 companies, so S&P 500, of companies that are still earning money and doing well, but just not as good, right? So in this reporting season, we're going to be looking at all of those other companies that are in that 400, 300 and whatever, to see how the broader economy is going to be moving. And I think that's really, really important. And then taking advantage of the growth side of things, because if interest rates do come down, growth will be back on. And that's where we're going to see these another sort of 493 companies really starting to move, because they're going to get that growth going forward. So we've always had in the portfolios the Qual, which is an ETF. It's a quality ETF. It's done really, really well. Basically, it's one ETF to rule every other ETF, and that's that ETF, which is quality. And the whole idea of qualities is that they've got low debt, high return on equity, high return on investment, and it's a great business. And that's the filter that they put through that. And that's worked really well for clients over the last couple of years. I think that one ETF in that global sense that I think, we should have, and we do have in all those portfolios. So I think that's that one there. Here in Australia, obviously we're a commodity-based market, so we need to be mindful about what's happening, because US dollar comes down, commodities start to travel higher or start to move higher. And then from there, you start to see some of these businesses really starting to make a move. Now, lithium has been one of those ones where we've started to see the potential of the bubble potential of what lithium can do. And, we know now that how many internet devices do we have in the home versus what we had 10 years ago? There's 30 internet devices now versus 2 that was, sort of 10 years ago. With that, then obviously batteries are needed to grow and to move forward. So now batteries are in cars, on your solar panels, there's batteries everywhere. So lithium is one of those ones where it is a massive component of that battery that needs to be moving forward. So copper is another one of those, and we really like some of the copper. We've done really well on wire. There's some other copper trades that we've done. But what's happened is that obviously everyone gets excited about lithium because they think that the potential is going to be there. And then from there, reality starts to set in. How much is actually going to be needed? Does Tesla need all of those batteries? Yes, they do. But the story the other day, there was 600, 700 cars sitting on the lot down in Sydney, probably in Melbourne as well, but they're not moving, right? So they're just not moving. So there's this transitionary period that we've started to see. But what you want to be doing is, if you are looking at any commodity and looking at any commodity stock, is that you've got to look at how much does it cost for them to get it out of the ground, and you've got to be in the lowest cost producers. So say gold, well, let's say iron ore. So BHP can produce a ton of iron ore for $20, right? $20, that includes their dividend. Spot price at the moment is $110, $120 a ton. They're producing over 155 million tons a year. That's just BHP. Then you've got Rio, Fortescue and Roy Hill, which is Gina Rinehart, the private side of things. So there's a lot of money that is being made on just iron ore. But you don't want to be in these producers that cost them $100 a ton to make it, because they're the marginal producers. And when commodities come down, like lithium has, it takes out all of those marginal producers, and they're not even worth investing in. So you've always got to look at who is the lowest cost producer, who's obviously good management, but the lowest cost producer, because they're the ones that you've got to be in going forward. So one of the stocks that we've invested in is PLS, which is Pilbara Minerals. The reason why we've invested in it, they are one of the lowest cost producers, with IGO as the other producer, independents. But Pilbara has 20% of their register on the short, or short register. Now, short meaning that if the stock goes lower, the shorters make more money. So at the moment, there's this tussle in PLS, or Pilbara Minerals, of both the shorters and the long holders of it. And if the longs will win over time, because the lithium price has come down, but it has now stabilized, and it will start to move higher again. And that's where you'll get these issues, or that's where you'll get these shorters having to cover the stock. And then from there, you'll see this big pop, going forward. But we've been waiting for a while on that one, and it hasn't happened just yet. But you want to be in any commodity, you want to look at those lowest cost producers. Now, uranium is another one that's done quite well over time because of clean energy. They need to have this transition to clean energy, and uranium, or nuclear energy, is certainly seen as one of those ones going forward. But what happens is that you've got all of these companies now that are starting to go back into these mines and really start to move. But it's been tough because the perception of the world is that they don't want another Fukushima.
Yep.
Right? And so that's totally understandable that you've got that there. So yeah, there's lots of things that are going into investing, but we're looking at that uranium price, we're looking at the copper price, we're looking at the lithium price, and we're sort of positioning portfolios to get to where they need to be. But you're sometimes going to have to wait just a little bit longer because of that cycle that's happening in the background.
The difficulty with it, and again, having these conversations with clients, is just opening their eyes to the uranium side of things, because it has been shunned for a period of time.
Yeah, 100%.
And I know Sam's a super passionate uranium man. And he sort of said, let me talk to any of them and, run through the numbers and the stats and everything behind this, because it's just bubbling away. But I think in Europe, correct me if I'm wrong here, is they've sort of starting to get back on board, and they've got a lot of plant over there already, but that's starting to take off again, correct?
Yep, definitely. France is the biggest one. They're turning on reactors everywhere for that. They really are turning that on. So, you look at the big uranium producers, and one of those bigger uranium producers is Cameco. Now they've got Cigar Lake in Canada. And then you've got this small little company that we've done a bit of investing in, is NextGen, NXG. Now, NextGen is coming on to production in 2 years' time with one of the highest grade uranium mines in the world in Cigar Lake. Cameco is going to basically run out of feedstock, or run out of uranium in guess what? 2 years' time, right? So we know, remember when Newmont took over Newcrest?
Yep.
Newmont had a mine life literally of 3 years. Newcrest had a mine life of 21 years. So what did they do? They just bought the biggest gold producer in Australia to keep their mine life going, right? So that was it. So what happens now is that you've got Cameco running out of uranium in 2 years' time, NextGen starting to production in 2 years' time. Everybody can join the dots here somewhere along the line there that it potentially is that they're going to have to buy NextGen to keep the mine life going and things like that. So that's why we're positioning certain, because there are a lot of other uranium stocks that we're lukewarmish on, but NextGen is one of those companies that we're very, very confident that that will happen, or that at least there will be some kind of activity that will happen, because Cameco, the largest producer in the world, can't continue to keep going into the spot market to buy their uranium to keep their contracts going. They're just going to come in and take this thing out. So NextGen has got, I think it's another 3 months until they've got most of their permits in place. Once they've got their permits in place, then Cameco can basically come in and just take it over. Might happen, might not. But yeah, we're sort of confident that those kinds of things. So we're making sure we're picking the right ones inside of
with that. That's probably the comment I was going to make, is in people that aren't getting advice around their investments specifically, is they think they can buy anything that's got lithium or anything that's got uranium or anything that's, had copper or iron ore, and just make money out of it.
Yeah.
When all those markets are competitive amongst each other as well, and they can't all do well. They can, in periods of time, they might do okay.
That's right.
But if there's going to be any pressure, that's what really separates the really quality providers.
So when the commodity is moving up and everything's good. Like the tide rises all boats, right? So all the lithium or all the uranium or copper stocks will go higher. It's just when there is a downturn or there is a cycle that happens, and we are in cycles, and so those marginal producers where they can't, the cost of to produce uranium or gold is higher from where the spot is, then they're losing money. Then that's when you really struggle. So yeah, you can throw a dart at a dartboard and pick, not a problem, but that's not going to get you the whole way, because as we know, these happens in cycles, and sometimes you can be on the wrong side of that cycle.
Using BHP as an example here, I know over the years this has come up, and clients have had this conversation probably with Sam himself and us as well. If iron ore prices come down significantly and end up in, let's say they're in the 40s or the 50s for an extended period, BHP will go down in price, but how many of their competitors cease to exist? And you sort of touched on this earlier, is that if it stayed down there for a long time, they probably wouldn't be the ideal world. They'd make heaps of money always, but they'd probably they would make even more money when it regulates its price again, and they've got an even bigger market share.
Yeah. So they'll always be profitable, right? So it's just how much profit, right? And so BHP is obviously diversifying their business a lot. They're moving into copper. They bought Oz Minerals. They're looking at phosphate, which is going into the production to keep the soils agriable so that people can feed and live. So yeah, they're sort of big long-term goals that these guys are doing. But certainly iron ore is the key. And if iron ore got down to $50, all of the Chinese producers would be out of business. They would be out of business. And that then leads back to us being in Australia, that we're one of the best producers, highest quality, all those kind of things.
JB, any specifics you want to throw at him, or are you just trying to get your head around
I love it.
Things? It's good, isn't it?
Crisis creates opportunity at many levels.
I say, and we've said to clients, and especially, we've had these conversations with clients lots, is sometimes we actually want things to be really bad. Like as they're entering, we want the market to be terrible for a period of time here, and then we'll fill our boots, and then we'll sell off later on. And again, sometimes with BHP to an extent, like that cycle is actually what makes it even more strong. It adds its strength over time as competitors just fall by the side.
Yeah, so like if you think about it, I'm going to see probably another 3 to 4 cycles in my lifetime, right? Which is just going to be, this sort of boom and bust, And so I'm happy to have another downturn. And I think we've got another year and a half of good returns. And then we're going to find something else to worry about. And that's where we're going to see this next. The hard thing is if it's another GFC, which is 2 years from top to bottom, that hurts, because that's a long time of turning up to work every day and continuing to see portfolios getting negative. But I'm all for a flush out, and I'm all for it. Just creates that opportunity, and you never waste a good crisis, right? Never waste it. You always take advantage of it. And it's the analogy of, when everyone's running away from the fire, you got to be running towards it and getting in there and buying and sort of picking up the good stocks. We've got a shopping list of stocks that we'll look at if there is a downturn, we're looking at those stocks and we're going to be picking them up. So it might take some time though, and I think that's what people, they're not patient, or they don't want to. They just want to be invested. Where sometimes some bit of precaution, a bit of patience should do quite well.
It probably ties back into our portfolio balance, and probably where, again, how our relationship works best is where we're looking at that client's situation scenario, knowing their cash flow, knowing what they need to have set aside, knowing that when that time comes, because it will,
Yes.
how much is available to start sprinkling in, and then having conversations with you about, right, let's break it down into 5 installments over the next year, or maybe they've only got enough to do a couple, working out those things, but knowing that all of our clients always have some powder dry to be able to attack that market. So we have enough in there that we, through the next 18 months, we do well. But if we get 6 months in and there is that crisis comes early, well, it's all right. We can jump in and we can nibble away and have a bit more fun with it as well.
Yeah, I was just thinking that the risk is that, again, you do nothing and you don't prepare for that eventuality, that downturn. And if you're scrambling, trying to get your shit in order, trying to work out what your cash flow is like, what your liquidity is like with your other assets, whether you've got good people in your corner to make decisions on what you should or shouldn't be buying, then it's kind of too late, because those moments can be fleeting, and you got to have people in your corner to be able to do that due diligence, and you need to be making sure that you're prepared in advance. And some of that is about, like you said, Adam, having patience and being prepared. And not everyone is great with that, but that's where having people that are unemotionally involved in your own situation to guide you is super important. Maybe still on the stock stories, is there any other, let's talk sort of domestic stock stories, is there any other notable stock stories maybe specific to our client portfolios that you're either, Ben's got here something that's gone out or something that's come in, something that is noteworthy that our clients listening to will be able to resonate with?
Yeah, so we've started to see some value starting to come back into this market, but it's more sort of sector-based value. It's not sort of broad-based. So something that we're adding to portfolios, and it sounds pretty boring, but it's Woolworths, right? We've been adding a lot of Woolies into clients' portfolios. Now, Woolies has obviously had some issues, and we call it the Qantas effect, right? The Qantas effect is basically that if you've got this issue where Woolies has basically, been told that they've been price gouging, and the whole supermarket has, that they're sort of, their margins are 2 to 3%, right? So for every $100 they make $2 to $3, right? I don't know if that's too much, but when you're talking billions and billions, right, that's a fair bit. But the effect that Woolies had, and it's the Qantas effect that, Qantas got a bad rep because they were booking flights that weren't there. They had all this kind of stuff. Alan Joyce leaves right at the top, sells it all, and disappears. And then, there's a national inquiry and all these kinds of things. Woolies has gone through the same thing. And this is the time where you start buying stocks that have been hit hard, and they're good quality blue chip stocks. And so we've been adding Woolies into the portfolio, and that's actually now starting to turn around. Woolies is now bottomed and starting to move higher. So that's a good one. We've seen Worley's is another one that's done, it had a big, large seller in there. It's been hurt because of that sort of cornerstone investor started to get out. But that business is still a fantastic business, and we're taking advantage of that sort of downturn, going forward. One of the, obviously in the portfolio that we don't tolerate, Star Casino. We've been getting out of that for any clients that have got that in there. Not because it's gambling, but it's a horrible business. And
it's been on the way down for many years now.
Exactly. Right. So there's a lot of people saying that there's a lot of value in that, right? But there's a reason why it's down where it is at the moment. Like, it's just really tough. We've sort of been, some of the healthcare stocks have been really tough. Like, we did well in Ramsay. We got in, and then we sold a lot of clients out of that sort of $80 when there was that takeover. Now it's back down to $40 again. We're starting to think about looking at Ramsay again. They got some issues that taken with the French government. That's been taken care of now, so the margins are okay. So some of the healthcare stocks, obviously we've done really well on ResMed. We're umming and ahhing whether it's to start to take some profits on ResMed. It's a $30 to $33 stock all day long, and that's where it is at the moment. We were buying that back in 2022s, 23s, and every client portfolio that came through had ResMed in there, and they've done well now. It's what do we do here now? Do we take some money off the table? So there's definitely value in the market, but it's more sector-based and it's more individual stocks, not just a broad market value. So, and what else are we putting into stocks? Obviously we still think copper has a long, long way to go in that energy transition side of things. So we've got wire, which is an ETF, copper ETF. That's doing very, very well. We did Samphire for a couple.
I'd say, are we still buying that? I think a lot of clients have probably, nearly doubled their money, maybe loosely.
Yeah.
Very close to it on that. Is that something that's still coming in, or is that one is it more of a hold pattern?
It's holding at the moment, but copper still has a fantastic story that will continue for the next 3 to 5 years. And the reason is that, like a lot of these other commodities, there's been underinvestment in new mines. In fact, there's been no investment in any new mines in copper because it's very hard to find. It's very hard to produce, and hence why BHP took out the best copper stock on the Australian stock market, which is Oz Minerals, right? So we know that copper is a fantastic transmitter of electricity, and it transmits electricity at a low temperature, and that's what you want. So there's all of these things that are sort of going for it. So we still see copper as a long-term buy going forward. Data centers have been a really good one. We haven't got a lot of data centers in the clients' portfolios, but that, again, is something to that sort of transition and those kinds of things. So, yeah, there is certain value out there. We're definitely steering clear of the CSLs at the moment of the world. I think, CSL is one of those businesses that has always been a darling for the market, but they're struggling. They really are struggling, and it's underperformed over the last 6 to 12 months, basically going sideways. So I think you can still invest in it, you can still hold it, it's a great story, but I think, you just got to be careful within your sectors. The banks, obviously, Macquarie. Telstra fell down to 360 the other day. I picked up some for a couple of clients. They laughed at me when I said, Telstra. They were like, well, dividend's not there. Yes, you're right. But look, if we can get $4, $4.20 out of it, buy them at 360, that's a good trade. So, and it's pretty safe as such. So, so we're finding some certain pockets that are looking good in there. But, you got to be careful, though, because you've got to know your market and you've got to know your sector. And one thing I have really, really learned over many years of doing this is that in your sector, you want to pick the leader in the market. You don't want to be investing in the second, third, fourth tier guy. You want to be in that number one spot. And I think that, you look for the sectors and you look for the businesses, but you're always picking the best of the bunch and the best of the breed. And I think if you do that, you'll be better off than trying to pick the next up and coming one, because that usually doesn't work.
The quality stacks up with most things.
Yeah.
Question with one that I think has come in for some and then out was Treasury wines.
Yeah.
Is that just a comment on that one?
Yeah, so Treasury wines now obviously got hit very hard with the Chinese tariffs that came in, and that really stopped TWE Treasury wines from really sort of doing it. But they were able to then move all of their stock into Vietnam and then get it into China, right? So they were like prohibition. They were able to move alcohol at any stage of the process. Now that the Chinese government has taken those tariffs off, it does lift the business up to be obviously a lot more investable now. And I think it's around the balance sheet that we were sort of concerned about at the start. Balance sheet has been a little bit tough, and those tariffs. So the tariffs now been lifted. We're okay with Treasury wines, and I'm okay holder of the business because it's actually not too bad. But basically, Treasury wines, 10% of its business is Penfolds, but that means I think it equates to 90% of their profitability, right? So only 10% when you got Grange and you've got all these lovely Penfolds wines, but that equates to most of their profitability. So they've gone out and bought Napa, they've gone out and bought all these other wineries, and it just hasn't worked. It's this Penfolds range that is really sort of what the market and what is basically driving all of that growth. Now, Chinese they love Australian wines, and they love that status symbol of having a Grange, or they love the status symbol of doing that. So Treasury wine has been hit by all that lower cost yellowtail wine, or those, those lower end wines that they have to sort of in the glass.
The stuff you drink a fair bit, isn't it, Ben?
The cheaper the better.
With pizza. Yeah, so Treasury wines is a good investment. We're happier now because it has got rid of that Chinese tariff, and that sort of allows us to be more confident.
Were people probably expecting once that tariff went that it was going to sort of, I think, immediately just fly through the roof?
Yeah.
So, and then maybe, again, it didn't do a lot, I don't think, off the back of that.
It didn't, you're right.
Because nothing changed immediately.
Yeah. So it has to be in a 6 month and a yearly where you get the cycle, and then the profitability starts to come through. But like I said, they were just moving it through to different Asian countries and then moving it into China, right? So there's a little bit more of a margin compression because you got to move it from one to another. But then, the business was still going. Another one is A2 Milk. I mean, that's been a good investment, but a tough one as well. That we're sort of looking at that one. There's a couple that we've got sort of sitting on the sidelines waiting. We're just sort of waiting for something to happen. And That gives us the impetus to then go in and start buying it. But it has to have that fall, or it has to have that sort of flush out before we'll go into these things. And that's sort of where the patience, I know it's tough, but it's the patience that we need.
Just going back to one of the early, you talked about NVIDIA, talked about the scope of that, and AI, maybe just on AI and AI adjacent stock domestically. Is there anything domestically that you think will be a beneficiary of being AI adjacent in the coming years that you want to speak of?
Yeah, so I think something like a Xero, I mean, it's a technology stock, but they're using a lot of AI in the business to do, sort of look at taxes, those kinds of things. T&E, Technology One, has done really, really well. That's a lot of AI focus there. Australia doesn't have a great tech space. And even if you do have a look at some like BrainChip or something like that that's using AI, really, they're struggling. There's no revenue coming in the door, those kinds of things. The one that we have really we're taking advantage of is the data center growth. So Goodman Group, I think we've got that in a lot of clients' portfolios, and we're in there a lot earlier.
Is that still adding, or is it a hold now? Is it more of a
$30-something? It's just
big profits in a probably 18 months period.
Yeah, so we're not selling it because the data center, which is what AI is using, the data centers to drive the brain power of AI. Goodman Group has just been one of those fantastic stories. And so you look at it, and Goodman Group's obviously industrial parks, but they've got enough land to be able to then house these big warehouses for data centers. Now, the issues with data centers, I think I saw a stat the other day that AI is using like I think it's 30% of the global power to suck. Like, it's making our lives easier, but it's actually not ESG. It is just sucking the power out of everything.
More windmills.
More windmills to
more solar
power going.
Panels on everything.
Yeah.
You stand still long enough, they'll stick one on you.
So I think Goodman Group is definitely one of those ones that we're holding. I don't know if we're adding to it too much at the moment. It had its run, and we're really, really happy with it. We've done really, really well on it. They got included in a couple of Asian mandates about 6 months ago, and that's where we've really started to see that sort of rise. And there's a lot of businesses, a lot of fund managers, businesses in Asia and around the world that can't invest in China. And they see as Australia as a proxy, like the banks. We saw the banks rallying, 6 months ago, 4 months ago. They were buying the banks because it was a proxy to get into China. Goodman Group was another proxy of a way to get access, even though we're obviously a long, long way from China, but it's in the investment side of things, we're seen as a proxy to do that. So Australia's been benefiting from a lot of that money that's been flowing in there. So yeah, Goodman's a hold. We wouldn't be selling it because it's a fantastic business, but we probably won't be adding to it.
Yep.
But I think data centers is the way that we've been, to Jay's point, is the way we've been playing AI. That's how we've been playing that AI, is that data center business.
Quick question on, we just mentioned it there about ESG. What sort of, again, it's sort of, last week we had a day of education. And
do you mean impact investing?
Yeah, well, they've rebranded it to try and get some more impact. Yeah. How much demand do you actually see for it from your perspective? We probably talk about it a lot because we have a lot of presentations and it gets introduced to us a lot. We definitely have had clients who ask about it and talk about it. What it means for every different person is completely different. So that's been an issue with it. But also we've probably felt when markets have been a bit tighter and maybe interest rates have been higher and people are a little bit more worried about their own backyard, is that the interest in it broadly has fallen away. Has that been the same from you?
100%. So anything that had 6 to 12 months ago to 2 years ago, anything that had a green tinge to it just got bought up. And there was this sort of wall of money that was coming down from the ESG side of things. Now what's happened is that it's not that it's old story, but it's something that's really sort of come back and it's not so high on the list. As you say, it's not high on the list. Now, they still want impact investing. They still want to be environmental. They still want to have social ramifications, and they still want to see governance. They still want to see women on boards. They still want all of that, but it just doesn't have the following anymore, that sort of push.
So they also want to make money.
2 years ago, a year ago, you were making money. There was no problems there at all. You would definitely be able to make money, right? So there's a business called Calix that we've invested in, CXL. It's a business that takes, from many other things, but takes heat out of cement production, right? It's a fantastic business. That heat out of that cement production, and they've got other ones for lithium, and they've got some of these other things, they've got ongoing royalties in perpetuity for these businesses. So this business is making money without even doing it, without even getting out of bed. Perpetuity, they're getting royalties off this technology. But the stock's gone from $9 to $2 and nobody wants it. Nobody wants it at the moment. It's a perfect ESG stock. It's got all the hallmarks. It's got everything. And we're underwater for clients, but I'm not worried because I know that this business will do very, very well over a longer period of time. We should be starting to buy some more of it. But it's just people have just moved on a little bit and want to make money, and it's been a tough space to make money. I think it's got a lot to do with companies that have said they put a shingle on the door saying that we're environmental. But when they actually go in there and lift the hood up, you're not really environmental. You're just putting a shingle on the door saying, or fund managers saying that we're doing this. But they invest in BHP, they invest in, all these things, or, funds that are saying that we're green, but you actually go in and look at their investments and there's no way that they're really, and they have to keep up their returns. So, they want to make money. So I think that we're in part of that cycle. Part of that cycle is that people know that they want it and they're happy to pay for some of it, but it's really sort of, been pushed to the side a little bit. And I think it will come back. There's no doubt about it. It will come back, but it's just been a bit tough of late.
Perfect.
Yeah. I'm mindful of time.
Right.
We've got dinner tonight, so we better go and get spruced up. Put your best Burke Britain polo on, Ben. Maybe fresh one. Yeah. Adam, thanks again, mate. Appreciate the update, the comprehensive update. I know we could talk to you for hours on these topics.
I love talking about
stocks. I know. Yeah. It's evident. So I suppose another big thank you from us and our clients and all the team here for what you and Sam and your team do for us. Thank you again. For those of you listening that don't know Sam and Adam, whereabouts can they find you guys on the interwebs, or how can they get in contact with if they wanted to?
Speak to your financial planner is pretty much
right answer
to us. But no, like for us, you just search my name on Google, you'll find me. But we're at Shaw and Partners. That's sort of where we are. And I'm on LinkedIn, all those kinds of things. But yeah, speak to your financial advisor and then we can organise meetings. We're more than happy to meet up with any client. If you want to have a 5-minute chat, or 10-minute or an hour chat.
3 hours.
Yeah, we can.
Careful what you wish for.
We're more than happy to do it.
So we've got Trump's going to win the election.
Yep.
No rate cuts this year. And
18 months shit hit the fans.
Yeah.
Shit hits the fan, yeah.
Yep.
Good, we'll take that.
Perfect. Good way to wrap it up. Thanks, Adam. Thanks, Ben. Cheers. We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britain FP, or Google Burke Britain Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britain Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.